Alright, so even though this is our website, myvariation.com.au, and you might already be there looking at this video, but what we're actually talking about is the PAYG variation service, and that service is something that we do as part of our specialised system for property investors, and trying to have them work to a better system of cash flow management in relation to investment properties. Because one of the biggest issues that we have with property investments is that people don't manage their cash flow, and they actually reallocate their money disproportionately to the wrong areas, which means that then when they come and review their investment property each year, they might be saying to their advisor, why am I with this property? This property isn't working for me. You told me it was only going to cost me $20 a week, but it's actually costing me $100 more, so $120 a week, and it's compromising my lifestyle, all that sort of stuff. So what we do with the variation service is actually help you manage your cash flow better and really identify how the property works. So there's a couple of things that we recommend with the variation service, and that's also around the mortgage structure as well and budgeting. So there's a couple of important parts that I would say. One is that you need to budget, right? And so you manage your money properly. So you can either do it yourself or you can work with somebody to manage that budget and help you with that budget. The second part is have an offset account structure set up correctly so you can identify where your money goes. So if we have our loan account here, what we want is we want an offset account structure where we have multiple offset accounts. Some banks don't offer that service. If they don't, move. Right? That's the simple nuts and bolts. But we want offset account number one, and I'm going to assume we've got just one extra property for now. So we want offset account number two, and offset account number two is going to be for your investment property management. Right? So now, what are we doing with the variation service? The variation service, we're actually doing a tax return in advance. And someone put it very, very cleverly. Why do we want the tax office sitting on our money for a whole year? Because it's our money. Right? Why do we want them sitting on that money for a whole year unnecessarily when we can get it back straight away? Right? So I've got some general numbers here. Let's say that we have an investment property and you've been told that it's going to generate a refund for you of $5,000 a year. Right? That's equivalent to $100 a week. So what do we do with this service? We do your tax return in advance, so that's us, and we tell the ATO, as tax professionals, that we actually know that you're going to get a refund at the end of the year, and that you are entitled to that now. Now, most people don't know this even exists. So then the ATO will tell your employer, hey, take less tax out of their pay cycle.
So we don't need to do anything after you tell the ATO. They tell our employer, we don't have to.
Yeah, it's an easy process for you, Jess, right? So basically, we do all this, and then the ATO sends a letter to your employer, and then the employer will take that amount of tax that the ATO tells them. They usually tell it as a percentage. So they might look at your percentage and say, oh, you're normally in the 34% tax bracket, but we want you to make your employer to drop it down to 17%, and then you get that differential, right? So it's an easy process. The only thing you need to monitor is that it actually happens, that the letter gets sent out. So after 2 months, it shouldn't take any more than 28 days. So after 28 days, if the employer still hasn't done it and they haven't got the letter, well then you would want to contact us and say, hey, we haven't received anything yet. Could you follow it up for us, right? But we do need to give them the 28-day processing, and due to external factors like pandemics, it could stretch that processing time frame out. Obviously, tax season is another high volume period which could maybe push their time frames around as well. But exactly right. There's nothing you really need to do outside of at the beginning. Give us some documents, right? So we can actually pre-model your tax return, And especially the first year, if it's your first tax return, it might be a few extra documents than normal, right? Because it's your first year with an investment property, right? But then after that, it should be pretty easy and you get in the swing of it.
So do we need to do a normal tax return every year as well, or how does that?
So you're doing 2 tax returns a year.
Right.
Correct. That's right. But the advantage is that you're getting money more frequently. And if you look at some of the other videos I've created around extra contributions to mortgages, you'll find that putting in money more frequently into your mortgage is going to reduce your principal faster, meaning you pay less interest. Right? And as we said, why do we really want the tax office holding on to $5,000 of our money for a whole year when we don't have to? Right? And one of the biggest things I hear from people is, oh, but it's for savings. Right? But my argument is, well, that's really laziness. Right? Because we should be able to do our own budget and force ourselves to save rather than the ATO sitting on our money, which is costing us, because this is our investment property account over here. We could have $100 each week going in there additionally, right, which then is being applied against our home loan. And if you check out my video on extra contributions, I'm pretty sure $100 a week slashed over $50,000 of interest on a 25-year home loan term of $300,000. So if I can save you $55,000 of interest, you know, I'm sure you're going to take that, aren't you? So that's basically how that works. And then, as I said, the biggest issue we also have is cash flow management, right? And so what happens is you buy an investment property, you're told you're going to get a refund of $5,200, but then what do you do with it?
Blow it.
You blow it. Like what would you blow it on?
A holiday.
Yeah, a holiday, right? Common. Holiday, car, furniture, you know, living expenses. But really that is a back payment that the ATO owes you for running your investment property. And I see it with probably 80% of the time when people don't follow the right structure, they come back and blame the investment property and say, hey Rick, you told me it was going to cost me, or Jim Smith told me it was only going to cost me $20 a week, but it's actually cost me $120 a week, and now it's compromising my lifestyle. And I'll ask everyone the same question, but what did you do with that $5,200? I went on a trip to Bali. Because instead, via the variation, that $100, it should be going into there.
So you got to do that yourself, though, right? So you set up your own deduction. Is that how?
Depends who you bank with, right? So if you bank with our mortgage management product that has the multiple offset accounts, we'll help manage this for you as best we can. But if you're with another bank, Bank SA or St. George or Commonwealth, yeah, this is something. But we'll guide you. We'll tell you, hey, you need to set up a direct debit for this much. And this is where the budget process is really important, right? But we'll guide you what you need. But yes, you'll need to set up the direct debit once the PAYG variation has been processed.
Is it worth everyone doing this? Like, I mean, like if you're on a lower income, is it still going to be beneficial for you?
Anyone that makes extra contributions to their mortgage more frequently is going to benefit. If you don't have a mortgage and you're renting, yeah, well, you might not benefit, right? Because you don't have a mortgage. So, but really, we're looking at people that have got mortgages. So, but even if your income's less, your income's not tied to your mortgage.
Yeah.
What determines how quickly you pay off your mortgage is the extra contributions, right? So I would argue if you want to go on a holiday, it's going to cost you $5,000. Don't use your investment property running cost money to do it, and instead save in advance, right? We can always bolt on an extra offset account for your holiday fund, right? So that can sit over here. And if your budget permits that the maximum you can contribute to the holiday fund is $50 a week, and you want a $10,000 holiday, well then really you need to be waiting 4 years before you go on that holiday, right? Not taking the shortcut and using this. Because then what happens is you're breaking your investment property strategy system, right? So it's fundamentally important that you follow the cash flow process to be successful with that property strategy.
And this whole strategy is about paying your owner occupied lifetime.
Well, of
That's
course,
correct, yeah.
yeah. I mean, in time, like you got multiple strategies inside a strategy. So the first one is most people are using investment properties to try and pay off their own occupier first, and that makes sense because it's a non-tax deductible debt. So why pay off a tax deductible debt when you can pay off a non-tax deductible debt? Once you've paid off your home loan, well then the question becomes, what do you do now? Right? Some people say, well, I'll sell the investment property, the job's done. And again, you've got to check out my videos, what's your magic number to really answer that question. Otherwise, the other one will be, if you start keep building an investment property portfolio, so you've got one here, you bolt in another one, so you've got two, right? So now you've got three running three offset accounts. Maybe you might target one of those investment properties and try and pay it off, which is going to be age dependent and income dependent for you, right? But there's nothing wrong once you've paid your house off of trying to own those properties as assets, because they're going to fund your lifestyle in the future by producing income.